Antoinette is the Stuart Myers Horn Family Professor at MIT. She has a very long academic bio with numerous contributions in actually a relatively wide area of fields. Early on in her career, she, for instance, asked some really interesting questions about the impact of managers in firms on what kind of style of management would be effective and whether or not it is effective at all, which helped us all really greatly understand just the value of management better. She has worked on private equity, tried to understand whether private equity managers are contributing value. And she has done a host of other research projects, obviously, on fintech, consumer finance, and financial intermediation. She has also received numerous awards. It's very humbling to read her bio. She won the Kauffman Prize Medal for entrepreneurship and the Brattle Prize in the Journal of Finance, the most coveted prize for people in finance, so to speak. She's the NBER Corporate Finance co-chair. She is an associate editor of the JF, the AEA Applied Economics, and the Journal of Economic Perspectives. And she's also co-founder of Ideas 42, which is a startup that tries to bring behavioral and psychology ideas to solve social problems. Today, she will talk to us about a blockchain analysis of the Bitcoin market, and we're excited to have her give that presentation. Antoinette tells me she will talk for 40 minutes, after which we're going to have a Q&A. So Antoinette, the floor is yours. Thank you.
Thank you very much for the kind introduction. And while I'm sharing my slides, let me also apologize that I can't be with you in person. Unfortunately, I'm actually down with COVID. So it's actually in everybody's interest that I'm actually not in the room. But let me actually share my screen and see. Can you guys see my slides? Yeah.
Yes, we can see your slides.
Okay, cool. Great. So thank you for having me. What indeed I want to talk to you about is a work that I did with Igor Makarov at the LSE, where we are using blockchain data from the Bitcoin blockchain to analyze the behavior and also the ownership structure and concentration levels of some of the main participants in the Bitcoin ecosystem. And obviously in this audience, I don't have to motivate why it's interesting to think about cryptocurrencies. But of course, what's interesting for all of us to understand is what type of data, especially data from the blockchain ledger, can we bring to bear to analyze behaviors, in particular, what I will show you, of the network structure itself and how transaction flows across the Bitcoin blockchain and, you know, kind of the connections between different counterparties. Second, I will show you some analysis that we have done on the ownership concentration of Bitcoin. And then finally, also on the ownership structure of the miners, which obviously, as you all know, are some of the most important intermediaries, if you want, or validators in that universe, because they are guaranteeing the validity of transactions and guarding, if you want, the integrity of the blockchain. And as you will see from the analysis that I show you, actually ownership of Bitcoin, even after, you know, kind of now a decade of wider adoption and a lot of interest from the public in Bitcoin, actually ownership is still very concentrated, and mining capacity as well is pretty concentrated. But in addition, I will show you how actually mining capacity also co-moves in its concentration levels with the price of Bitcoin, which is in particular interesting at the current time, right, where we're seeing a lot of volatility in the crypto markets. So with this, right, the first thing I just wanted to show you is, in a way, what we can do with the data on the blockchain. And of course, I assume most of you will be familiar with how the Bitcoin transaction looks, you know, kind of on the blockchain. But just to be clear, right, obviously, Bitcoins are stored in addresses. These addresses can be set up for free on the blockchain. And what's interesting, of course, is given the pseudonymity of the blockchain universe, we can trace flows of transactions across different addresses on the blockchain. And right here is, just to give you an example, right, is one transaction, this is the first panel, on the blockchain. So this address here, 17A16, blah, 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 right, sends actually 1,388 or has 1,388 BTC, right? Not bad. But actually what you can
see... To interrupt you for a second, because you're talking about slides that are not actually changing.
No?
Yeah, we still have your headline slide.
Really? That is weird to me. Wait.
No, that's good. That's the next slide.
Yeah, but it shouldn't be this way. Okay, maybe we leave it then this way. Can you see this slide?
Yeah.
Okay. Is it halfway full screen?
It's actually not in full screen mode at the moment for you. So.
But you see, the problem is when I had it in full screen mode, it sounds like for you guys it wasn't changing.
Well, now we can see it now. It works now. So.
Yeah.
Yeah, I hope so.
Okay.
I'll let you know if not.
All right. Let's see if this is a bit better. Yeah. Okay. So this is basically the first transaction I was talking about. So this address sends had 1,388 BTC in its address and is sending actually 0.01 to this address, 1F8, FDP, and so on, right? But, and that's obviously very important, is sending the rest back to itself, because the way the Bitcoin blockchain actually stores information is not as balances, but as flows. And that's really important, right? Because what that means is if we are not careful to differentiate the change that's being sent back to yourself from the actually meaningful economic transactions on the blockchain, we would think that in this transaction, 1,388 BTC was the total volume that's being sent. But that's not the case, right? As I show you here, in this transaction, it's obvious. Most of the value goes back to whoever is the owner of this original address. And here we can easily differentiate what is BTC changing to somebody else's address versus my own. Now, what makes this so difficult is actually that for many wallet protocols, when you send money back to yourself in a normal transaction, the protocol might set up a new address for you, because addresses are ubiquitous and free to set up, right? And so therefore, actually tying all the addresses that belong to a wallet in order to avoid the overcounting of volume is the first really difficult challenge that anyone has who wants to look at Bitcoin transactions and flows on the Bitcoin blockchain. And the way we can overcome this here is, of course, by being as careful as possible in tying all the all the addresses that belong to a wallet together. How can that be done? So there, we actually use another feature of the Bitcoin blockchain, which is the fact, and this is the second address here I'm showing to you, which is the fact that actually if you own a number of different addresses that you control, let's say, and you use them jointly within one transaction, I can see this on the blockchain. How? Look at this second transaction here. What this is saying is this entity here is sending 0.71 BTC to this address over here. But it is sending it from these 5 different addresses all together, right, to this new address. The fact that these 5 addresses are being controlled, or if you want, bundled within one transaction, means, this is how the protocol is set up, it proves that the same entity controls these 5 addresses. And so I can know that actually those 5 addresses belong to one wallet, or at least belong to one entity controlling it. And so you can now see, right, what I can do, and this is what clustering algorithms do, is I can use the fact that these 5 addresses have been used together as proof that they belong together. And so then I can basically backtrack the entire graph, or you can think the entire history of the, of the Bitcoin blockchain to figure out what other addresses have ever been used together with these addresses, right? And then iteratively, any other address again that has been used with any of those, and then build the whole tree. And that allows me actually to provide an approximation of all the addresses that belong to one wallet. And that's exactly what we do to create wallets. Now, I want to give you this in so much detail so that you also understand that anyone working with Bitcoin blockchain data will always only be able to see a lower bound approximation on the ownership, say, or on the transaction volume that a given entity controls. Why? Because if I can do what I just told you I did, right, it's also true that people who are intent to not show that they are controlling a bunch of different addresses on the blockchain, they can avoid ever using the same address addresses within a given transaction. And once, right, we are basically, so once somebody actually wants to avoid ever themselves utilizing addresses together, a clustering algorithm can actually not help you to then build these wallets together. So in other words, right, I might, for some people, underestimate the amount of Bitcoin they own, the amount of concentration, and even, kind of the size of different wallets. Yeah. Now, but basically this clustering that I explained to you solves my first problem, which is it does help me tie addresses together to different wallets. However, that still doesn't tell me who is behind those different wallets. And so in order, right, to actually tie the wallets to real world entities, which is, kind of not easy actually to do, we linked our wallets to real life entities using public and proprietary sources. And the sources we use, right here, I'm listing some of them for you, is places like NBER, Wallet Explorer, basically publicly available resources where people either voluntarily post their addresses or clients and customers of different type of intermediaries post addresses. But then we also work with the state-of-the-art crypto database and analytics provider, Bitfury Crystal Blockchain, who helped us fill out some of the maybe holes, you can say, or some of the large entities that we were not able to initially locate ourselves. And we are now, kind of working on other things with Bitfury Crystal Blockchain as well. All right, so what this means then is that we end up with a database of more than 1,000 of the wallets of the largest entities on the Bitcoin blockchain, 3,930 exchanges, the largest gambling sites, the most important online wallet providers, payment processors, mining pools. And then we also have information on confirmed addresses of scammers, ransomware attackers, darknet places, and other confirmed illegal services. And let me again say, right, illegal here are really these confirmed and identified illegal addresses. Some people often ask me, right, but what about, sorry, what about tax evasion? Obviously, tax evasion is illegal, but I cannot, from the Bitcoin blockchain, verify if anyone, even say interacting with an online exchange, has paid capital gains tax or not, right? So this is not what I'm, if you want, identifying as illegal, or what I'm classifying as illegal. Illegal here to me are these true illegal activities. All right. So with this type of data, Let me now show you 3 of the main pieces of analysis or information that we can glean from the Bitcoin blockchain. So the first one, actually, let me skip this because for this talk, it's maybe not so important. The first one is information on the real volume that flows across the blockchain. So this is as of the middle of 2021, which is when, kind of for this paper, our analysis stopped. But I can tell you, we actually, extended the analysis until the first quarter of 2022 as well, and it looks still very similar. So what's the big picture takeaway from this? So, kind of the left is the real volume, so in millions of BTC. The right-hand side are percentages of volume on the Bitcoin blockchain. Sorry. And the dark purple bin here on the bottom is volume flowing to exchanges. And remember, again, the important thing here is this is volume, on-chain volume that I'm tracking on the Bitcoin blockchain. So for example, this is when somebody holds BTC in a private wallet, sends it to, say, Coinbase to trade it and potentially cash it out, right? Or if you send BTC from your wallet at Coinbase to, say, Binance, because you think there are arbitrage opportunities to be had, when Coinbase sends BTC, obviously not person by person, but from their wallet to the Binance wallet, this would also then be tracked in my data. Yeah, and what you can see here is the volume generated by exchanges that are named exchanges, meaning that I know the name of and I identified. So these are all the very biggest, as I showed you before, plus, say, the volume, this is the bluish line here, from OTC brokers and smaller exchanges for whom we might not know the name, but we can identify them as exchanges based on the structure of the trading volume and the interactions that they have. You see that this by itself is already about 60% of the volume on the blockchain. Now, if I add in, and this is what this orange bar here is, the volume that actually goes out of exchanges and back to individuals. Remember, this is not double counting because I'm just looking at, volume sent to exchanges and volume sent to individuals here. You see that actually more than 75% of volume on the blockchain is trade related. And then what you can see here as well is that the very light, orangey bars here, if you want, or yellowish bars, are illegal services, mixing services, scams and gambling sites and so on, right? And you see in the beginning of 2015, this was still around, maybe around 3.5%, but by the end of, or the middle of 2021, this is actually now less than 1%. And of course, the reason is, and you can see this here too, right, to a large extent is because the volume generated by trading has gone up so much. The reason why it's important to point this out, right, is that this definitely suggests that the value of Bitcoin, that, kind of, or the type of transactions that are supporting the value of Bitcoin does not seem to square with the narrative that sometimes is still told that, oh, all of Bitcoin value is just because people think it's all, guns, drugs, and scams. I'm not trying to downplay and to say that drugs and illegal activities don't happen on the blockchain. They can happen, and I'll show you some more results later that actually that is still a problem, and from a welfare perspective we might not like it. I'm just saying for valuation purposes and what the market must be thinking about the value of Bitcoin, it seems very unlikely that the valuation is just supported by this tiny sliver of transactions, right, that we're seeing here. All right, so kind of this is basically the volume. Now, if we look at, let me skip ahead here. If we look at kind of the network structure itself and which ones are the most important entities on the Bitcoin blockchain, what you can see here is, so what we did here is to plot for you all the nodes on the Bitcoin blockchain that that over, say, the time period from 2018 to 2020 saw more than 500,000 BTC flowing through them. So this is just a way for me to make it easier to plot the largest nodes, right? Think of them in a way, this is a cutoff to show you the structure of the 10,000, it's a roughly 10,000 largest nodes. And what you see is basically in this graph analysis, the size of the blue balls is basically the size of the volume that flows through each of these nodes. And then the arrows between them, the widths of those arrows shows you the strength of the connection. And basically, you know, kind of what we see here is that the very largest nodes through which most of the volume flows, not surprisingly, are the really large exchanges that you probably all know, right? Binance, Bitfinex, Bittrex, Gemini, Coinbase, and so on. And on top of it, so maybe that's not so surprising, but what's actually interesting is that those largest exchanges are also very interconnected. In fact, they form an almost complete graph, meaning that each node is strongly connected with each other. And in particular, what you see, for example, here, right, is Binance and Huobi, very connected. You see the size of the width of this connection, but the same way, for example, Coinbase and Binance, or, you know, kind of Gemini and Bitstamp or BitHub, right, are very connected with each other as well. Why this is interesting actually is because those different exchanges sit in very different jurisdictions, you know, Hong Kong, the US, Japan, Europe, right, where even the regulation of exchanges might be quite different, but still, right, the flows are actually very interconnected. And so here, the interesting thing to me in this is that this is obviously points to the fact that some of the largest network nodes, meaning these exchanges, play a very important role in providing participants on the blockchain with liquidity and also the opportunity to maybe cash out and to buy Bitcoin. And you might think, right, that because they are so interconnected, and they are controlling most of or a large fraction of the volume, if we were just to say, you know, impose KYC and AML, I mean, anti-money laundering and anti-terrorism regulation on these large exchanges, we would in some sense control or make sure that none of the tainted flows can reach this network. Unfortunately, that is actually not true. And the reason, let me kind of go straight to this next, you know, kind of slide. The reason why this is the case is actually that there are lots of ways for experienced participants on the Bitcoin blockchain to circumvent some of the AML and KYC constraints, at least the way they are imposed right now. So what we did here in order to show you this, think of it as a proof of concept or an example, but an interesting one. What we did is we looked at Hydra Marketplace. As you might know, Hydra Marketplace is in fact the largest dark web marketplace on the web. You can trade anything from guns and drugs to people and any other disgusting thing you can think about on Hydra. In fact, the FBI, I mean, in FinCEN just declared Hydra, I think 2 weeks ago, on their sanctions list for also, you know, kind of sanctions in the war between Russia and the Ukraine. But that's, you know, kind of just to give you a sense what Hydra is. Now, what we can do with Hydra, because we know the addresses that are Bitcoin addresses that are interacting with Hydra market, we can trace the flows of Bitcoin of traders who are interacting with the Hydra marketplace and figure out whether those BTC end back up in, exchanges that you might know. And now, if you look, right, what's interesting is if you look at the orange balls here, so this is, again, graph analysis, as I showed you before. What the size of the orange balls show you is the size of the volume that comes from Hydra and flows into these different exchanges directly. Meaning, right, somebody cashes out whatever gains they made on Hydra, say, on local Bitcoin, Binance, Bitslato, TotalCoin, and so on. And what you can see, right, is the big bubbles here are all exchanges that are not imposing very strict, or say in the case of Bitslato, TotalCoin, and so on, no KYC verification at all. Now, Binance, right, recently, especially Binance US, has actually complied more with AML and KYC regulation. But Binance Hong Kong, right, still follows different regulation. But you could say, look, this is good news because, for example, Gemini, which is here, and Coinbased, which is here, right, the direct flows are minuscule. And so, they are doing actually on a, face value, the right thing in imposing AML and KYC norms. However, that's not the end of the story, because what we can also see, and these are here, these turquoise nodes that that I plotted for you. What you can also, what these are is basically Bitcoin flows that come out of Hydra, but flow to what we might call mixing clusters or pass-through addresses. So the BTC sit there for sometimes less than 2 hours, right? Often either go through a number of peeling chains and are mixed with maybe, what looks like clean BTC, and are then sent to Gemini and Coinbase. And that volume actually is quite significant, and it ends up in Gemini and Coinbase. And of course, the reason is that it is difficult for Coinbase and Gemini to trace the Bitcoin they receive, not just to this purple node, but basically what they would have to do is to trace it back to the last known and verified node that did AML and KYC verification, right? And so you can see, right, that this is basically a way, but if we don't do this, it is impossible to guard, if you want, US or European Western exchanges from also receiving tainted BTC. And then it would allow actually illegal traders and people, people who we normally don't like to have interact in our financial market to access this market freely, right? And so this is one of the challenges that regulation will have to solve. Otherwise, we are allowing basically this type of infrastructure to undermine the rest of our financial system. And of course, this is also important because this is what I just described is not just true for illegal flows out of Hydra, it's also true for tax evasion, right? We don't want to allow through this type of mixing and sending via peeling chain, we don't want to give a subsidy in the form of evading capital gains tax to one part of the financial system when we don't give it to anyone else, right? So this is something where at the moment, in particular places like FinCEN, kind of CFTC and other regulators are now thinking hard about, kind of how to solve those type of issues. And same is true for the ECB. All right, so so this is one challenge, and however, it's also one way of showing to you, right? Kind of the opportunities of using Bitcoin data on the Bitcoin ledger. Let me, in my remaining, I think, 5 minutes, now show you two more results on first, the ownership of BTC. So what we do is basically we use the information, from the blockchain and build algorithms that allow us to differentiate intermediary addresses from individual addresses. So why is this important, right? Many of you might be familiar that there's what is called the rich list of Bitcoin, right? So these are, many people are tracing the biggest whales and the addresses of the biggest whales on the Bitcoin blockchain. There are even whale alerts where people kind of are trying to think about when a whale is moving some money, will this have implication for the Bitcoin price and so on. But actually, by itself, those addresses don't tell us anything about the concentration of ownership of Bitcoin, because as I had mentioned before, right, some of the very biggest wallets on the blockchain, not surprisingly, are, for example, the cold wallet and the hot wallet of exchanges like Gemini and Coinbase and Binance, Kraken, and what have you, right? And if I just looked at the concentration of those addresses, it would be meaningless because, right, this is actually money held on behalf of many people, because of course, when you send your BTC to Binance or you buy BTC on any of those centralized exchanges, they are holding your BTC in their wallet and you're not holding it anymore in your own wallet, right? And so this would be kind of a meaningless exercise. So that's why we actually devised a number of algorithms to separate intermediary holdings from individual holdings. And, we don't have time in this talk to explain to you the details, and I would urge you to look at the paper, but basically we can use the utilization pattern, the trading pattern, the type of other intermediaries that an address interacts with to clearly separate intermediary from individual accounts. So when we do this, what do we find? So let me first show you, right? This is the holding of BTC in intermediary wallets from basically the beginning, so 2009, till the middle of 2021. And what you basically see, so here's 2022, but basically the middle of 2021, you see that about on aggregate, 5.5 million BTC is held on behalf of individuals or other entities in wallets of intermediaries. And so I'm actually taking those addresses and treating them as if they weren't concentrated in my calculation, because I don't know, right, how many people indeed own these type of BTC. However, I can look now at the rest of the Bitcoin volume, the Bitcoin ownership, and I can plot for you here the concentration of BTC ownership in the wallets of individuals. And here what you can see is actually that there is quite significant concentration. So for example, right, this is as of the end of 2020, we've done the same thing now as of, the middle of 2022. It looks very similar. What do you see is basically that the top 1,000 investors actually control 3 million BTC. And if you look at, say, the top 10,000 investors, right, what you will see is actually that they control about, the top 10,000 control about 5 million BTC, and then the top 100,000 about 8 million BTC. And I just want to assure you that, when we do these calculations, we took out, say, the wallets or the addresses of Satoshi Nakamoto, because we don't exactly know who that is, right, and how concentrated this is. We also actually took care of stale addresses and stale wallets, and actually the storyline stays very similar. So this is actually very concentrated ownership. And let me skip ahead. How can I say that this is concentrated? So one simple way of giving you a benchmark for concentration here is, let's just compare this to the wealth concentration in the US economy. Given that, so many commentators over the last decade have commented on how much the wealth concentration in the US have gone up and how kind of unequal it is, right? So this might be a reasonable benchmark. But if you look, say, for example, Zayas and the data from Zayas and Suchman show that in the US, actually the top 0.1% of wealth holders control about 16% of total wealth. That is including housing wealth and liquid financial wealth. If you look at the top 0.1% of Bitcoin owners, you can actually see that they control more than 26% of BTC wealth. So you can see, right, this is actually 10 times as concentrated as even the wealth concentration in the US, right? So this is still very concentrated ownership. And, kind of why should we be concerned, or why should we at least be mindful of this? Obviously, it suggests that any appreciation of BTC, kind of the price of Bitcoin that comes, say, from capital flows of the wider public flowing into Bitcoin will predominantly and disproportionately go to a very small set of holders for whom we also don't know who they are, right? But it will actually not be necessarily a story of, kind of democratization of the wealth in financial markets, right? So this is something, kind of we should be very mindful of. All right, so in the last, I think, 2 minutes, let me then also finish by showing you how the concentration of mining capacity looks like. As I'm sure you're all very, kind of aware, miners, the true mining capacity is typically not publicly visible on, kind of through other data sources. What we do know, of course, is the concentration of mining pools. And I'm sure you're all aware, right, is that mining pools basically are these, kind of loose cooperation of miners that band together in mining pools in order to co-insure themselves and co-insure their income from mining. We know that mining pools are very concentrated, right? And the top 7 mining pools control more than 70% of mining capacity. But that doesn't actually tell us how concentrated the miners are. And of course, it's important to understand how concentrated the miners are, because that will help us also understand where the power in the interaction between mining pools and miners is, right? Because ultimately, strong concentration of mining capacity would point to, a higher likelihood of the possibility of a 51% attack. And so here, what we did, right, is we are able to build basically for each mining pool a bespoke algorithm to trace the Coinbase rewards that the miner, so in this case here, for example, Antpool, receives on the blockchain and trace it through to the miners that work with Antpool. Again, right, I don't have time to tell you exactly the details of how we built this algorithm, but kind of please, feel free to look at our, sorry, the appendix to the paper. But what's the upshot of basically doing all this, right? Once we map the concentration of mining capacity, what we can see is the following. So if you look here on the right, what I'm plotting for you is the number of miners in an average month that control enough hashing capacity, to cover 50% of the total capacity. So the blue line is 50%, the red line is 40%, and so on and so on. And what you see basically, right, is that there is a lot of variability, but you can also see that there have been several periods over the last years, and in particular very recently, where fewer than 50 miners controlled 50% or more of mining capacity. And remember, again, right, that everything I'm showing you is a lower bound on concentration, because if a given miner has several wallets that they are very careful to never mix together, one couldn't actually see on the blockchain how big this miner is. So, kind of that's actually relatively small amount of miners that are controlling 50% of the capacity. In addition, what you can see from this analysis is actually that the concentration of Bitcoin volume, of hashing power, co-varies with the price of Bitcoin. So each time the Bitcoin price actually drops, so do the number of miners, and the concentration goes up, which also means that the latent likelihood of a 51% goes up, which is not great, right? If in times when the price anyway is dropping, in addition, right, the integrity of the blockchain also becomes more fragile. So, kind of this is something to have in mind when thinking about what are some of the latent risks and the behaviors of Bitcoin miners. I will skip, kind of how we can use this data to even identify where Bitcoin miners are located, but we show in the paper that actually, kind of through the use of the tracing of energy consumption, you can actually identify the physical location also of where different miners actually are located in space. So with this, let me finish. Hopefully what kind of you can see from this type of analysis is that actually a careful parsing of Bitcoin blockchain data makes it possible to actually shed more light on the Bitcoin ecosystem and its main participants. But we have to be very mindful about how to use this data, because as I showed you, right, there are lots of complexity in how to differentiate true economically meaningful volume from just spurious volume that comes from the way the Bitcoin protocol traces flows on the blockchain. And in terms of the, kind of the learnings from this analysis, as you saw, the majority of Bitcoin volume is used for trading activities, and it flows through the main and largest centralized exchanges. It's also true, though, that Bitcoin ownership is still very concentrated, and so is the ownership of mining capacity, which means that, kind of we should be very mindful in how we think about the latent risks to attacks to the Bitcoin blockchain. And finally, I also showed you that the current way KYC regulation is structured limits some of the effectiveness of of regulation in preventing tainted flows from entering into wider circulation. Thank you very much.
Thank you so much, Antoinette.